You never know how much time you have. For me, that stopped being an idea and became reality on August 22nd, 2021. The doctors put me on a ventilator and told my wife to call hospice so she could prepare for the day they planned to pull the plug. 6 weeks later, I woke up to an entirely different reality. I could not walk, I could not talk, I could not even lift my own arm. And I woke up realizing something else. I had not made the right preparations for my family. The plans I thought were pretty good fell through when it mattered most. That is why Fiduciary Alchemy welcomes voices that would have warned me about the holes in my plans. My hope is that you live a long and prosperous life, but I also hope you make better plans than I did. So tune in, take notes, and stay with us through the end when Bluesman Grindle and the Compliance Choir bring a word of caution.
Hey, I want to welcome Mark Miller. He is the president and CEO of Hilton Wealth. He brings 40 years of tax and wealth management experience. He helps business owners, executives, and high net worth individuals build, protect, and sustain their wealth. I know one of the things that's passionate on Mark's heart is bringing many of the tools that are available to larger family offices to smaller investors and delivering for them some version of the home office experience. And Mark has been on the Leaders and Legacies podcast. We're excited to have him on Fiduciary Alchemy as well. Mark, welcome.
Well, good to see you again, Craig. Thanks for having me.
Yeah, I really enjoyed our conversation last time. And obviously this is a podcast with a slightly different focus. Leaders and Legacies, of course, is about leadership. And not that there's not leadership in what you do, obviously there is, but the Fiduciary Alchemy podcast, we're focusing more on the actual practice. How do you, for example, let's just start off with one of the things that I know is passionate about your heart. What are you doing differently than what you've seen that's out there?
So, Brad Hilton, who is the grandson of Conrad Hilton, is my main partner. And we just kind of had this passion, and we have had for years, Brad even more than me, to say, because he's been exposed to kind of the institutional side, the smart money side of investing for years, and with generally older individuals that have a lot more net worth. And how can we bring those kind of strategies more down to Main Street and more the average investor? And I think that was a big deal that we were focused on, and we were all, really both of us were. We got to figure out a way that we could get these more advanced strategies a little bit more down to Main Street. So anyway, that's kind of the thing that's different, and we've gotten great traction with that, and we've just been able to show people how the wealthiest of the wealthiest truly invest. That's so much different than how a retail investor invests.
Yeah, and so what are some of those differences? What are the advantages of having like a family office that are not available to the average folks?
So the family offices is where a bunch of wealthy people get together, they kick around ideas, they give ideas back and forth to each other, but it's also economies of scale. So the advantages are less fees, less volatility in portfolios, which ultimately leads better returns, better safety and security, so people sleep better at night. I mean, the wealthy generally, although they often have a lot more responsibilities, they generally sleep better at night than retail investors because the portfolios are designed specifically for that. So they're not worried that the market could change and they could be down 30 or 40%, in a short period of time. So those are the main differences. And the other big difference is really, again, kind of along those same lines, is the wealthy tend to focus more on safety and foundational safety more than retail investors do. And how do I know that? Well, every time we have people that come to us, and let's say they've been retail investors for a long time, we look at their portfolios, we do, a risk analysis wealth analysis on where they are, and we find maybe they are a mid type of risk investor, a moderate risk investor, but then when we look at their portfolios, they're in the highest risk levels, and they don't even know it. They have no
Hmm.
clue. They're just focused on, well, the market's been going really well. I've been making great returns. This woman or man that's been working with me has done a great job for me. So wealthy investors tend to focus on safety and security more.
Yeah. And I'm curious, why do you think that is? And let me give kind of a premise for that, a little setup. One of the things I've heard Dave Ramsey say is, look, if you get in the market and stay in the market over, yeah, obviously not just him, but over a 5 year period, the market always rises. And so, if you have one pool where if you're taking income from your investments, okay, maybe you have something that over where it's less volatile. But if you're in it for the long haul, why worry about short-term risk and fluctuations?
Yeah, oh, but that's therein lies the problem because, and we talk about this in our book, Hilton Wealth, is when you deal with and just let it ride and just stay on the roller coaster, over time, actually, your returns will be less. Why? Because you have to be generally out of the market or sitting around not making returns for long periods of time when we have extreme volatility and your portfolio goes down. The best investors of the world, in the world, they protect their money more. So maybe they have a lot less drawdown and a lot less risk so they can get back to even faster where they can start making money again. By eliminating large losses, getting back to making returns faster, then you have a smoother ride. And when you have a smoother ride in your portfolio, you get better returns over time too.
That makes sense.
Yeah, a lot of people don't know that again because on the retail side they want you to believe that the best way to invest and the way everybody gets rich is putting lots of your money in equities and just riding the roller coaster. And when it's down, just don't think about it, it'll all come back. But generally, 2008 was a perfect example. People had to wait 2.5 years before it to quote come back. The other thing that the concept that people don't understand a lot is and people have heard this, but you don't think about it investing. Let's say you lose 50% in your portfolio. That means you have to make 100% return to get back to even. Okay.
Hmm.
So that's something that people don't really think because you've got obviously half the amount of money. So you've got to make 100% to get back to even and start, quote, making money again.
Yeah. No, and I heard some absolutely horrible numbers about the '08 crash of how long it took folks to get back. And
Yeah.
it was a long time. So how do you go about mitigating that?
So I'm going to use a real simple example. And sometimes we do this with even our extremely wealthy clients that have never even seen this before. We show them an investment pyramid. And, the concept of the pyramid, there's a reason why the pyramids have been around for thousands of years. It's
Hmm.
because the base is massive. So in investing, the base is safety and security. So no matter what happens, no matter what storm hits in your investment portfolio, you're going to weather the storm if you make that base stronger. So what does that mean? That we may in a portfolio, like in our true wealth portfolios, we may have 50, 60% of the money in a pretty strong position. Now, the good news is we're on the institutional side or the smart money side, so we can still make pretty good returns in there, but making a lot of that money guaranteed, safe, very secure, has very little volatility. And then maybe take the other 40% and take risk with that. That's more of a wealthy of the wealthy investment model. So, like Warren Buffett's a perfect example. Everybody sees him and goes, look at all the money he's investing in all these companies, right? Value
Hmm.
investor. That's all he has. Every single bit of his money sitting in those. No. Right now, actually, he's sitting on a massive amount of cash because he's looking for opportunities and concerned about a market turn. But generally, his portfolio, 50, 60% of it would be in very safe, secure types of investments. And then he can gamble with the rest of it and still make incredible returns and be considered one of the greatest investors of all time.
Yeah. It's funny you mentioned Buffett. We helped a client get a blog article ranked number one for the search term "stay in cash."
Mm,
It was all about Warren Buffett, and it was just a question. This was like 2017, and Warren Buffett was sitting on 100 billion in cash, and people are
yeah,
like, "Look at all the cash he's sitting on. What's the
yeah,
signal?"
yeah,
And they said, "Well, just having that cash allowed him. When he saw a bargain, it's like you're
yes,
walking down the street and you see somebody has something on sale, and you're like, oh, well, I have the cash to pay for that right now."
yeah. It doesn't necessarily mean that he's out of the markets because he believes the markets are going to crash tomorrow. There's a number of reasons why wealthy individuals have money in cash. Many of our folks have money in cash because simply for opportunities that will come along.
Yeah.
That's actually a wealthy of the wealthiest strategy. So if you're sitting there and you've got every single penny of your money deployed and a lot of it's illiquid, then you can't take advantage of opportunities as they come. So, and I'm not saying, I think it's a little bit of both with Warren Buffett right now, but he's the one that you've always heard this, and most people have heard this. His first rule of investing is don't lose money, right? His second rule of investing is look at rule number one. Right. So
Yeah.
does that mean the picture that everybody has, and he's investing in all these companies and 100% of his money is at risk? And what if one of these companies goes bad? No, he's doing the smart money strategy. He's got the majority of his money sitting in cash that is there for his base on that pyramid. And then if something really goes wrong, guess what? He's still got his base intact and he
Yep.
can still recover and do well. Whereas a retail investor, like most folks that we see, might have, 70%, I would say, is probably the average that we see of 70% of clients' money when they've been on the retail side, and even very wealthy people when they come to us, and they maybe been with Fidelity or Edward Jones or one of these retail platforms for a long time, and they've made some decent money, but 70% of it is generally exposed to the equity markets. And they have no clue. They don't
Yeah.
even know that. They're just like, hey, I feel like I'm making money, I'm doing okay, but gosh, I can't believe how much money I lost in 2022. That's
Yeah.
because 70% of your money is sitting there at total exposure. If something really goes bad in the world or the economy, then, they could literally be wiped out. That doesn't happen to the wealthiest of the wealthy. That's why you never see people dropping off the Forbes 100 list in droves. It's not like they're rolling the dice and hope that, every year they make 50% return or whatever. You'll see those same people year after year after year that are in the, top 10, 20, 30, 50 on those lists.
Well, and here's a concrete example involving Warren Buffett from the '08 crisis.
Mhm.
GE was in trouble and they needed a loan.
Mhm.
If all of Buffett's wealth was tied up in equities, his equities just tanked, but he was sitting on a chunk of cash.
Yeah.
And he made a loan to GE. He made a $5 billion loan to GE that would make a payday lender blush.
Yeah.
And I think he made 3 billion in profit in like two or
Yeah.
3 years.
Yeah. What are that? That's bridge loans. And bridge loans that we do a lot with Hilton Finance in that area because there's all sorts of opportunities of companies. They're really good, strong companies that have the ability to pay back that get in a position where they need to. Some companies even operate on that model because they make so much money. They're just like, hey, we'll bring in capital when we need to bring in capital from different bridge source area like Berkshire Hathaway or other companies that Warren Buffett has, and it's worth it to them for maybe a short-term period of time, 6 month or year period of time, to pay 20% on that loan. Because of that, they kept their business model operating, or they use it to stack another department or another revenue source, and they've just made 50 or 60 or 70% on that money in that period of time.
Yeah. I remember from '08, they had built a brand new mall right next to our neighborhood and spent 192 million building the mall.
Hmm.
And when they had to convert the loans from construction loans into regular operating loans, because the financial crisis, nobody would write the loan.
Right.
That mall went on the auction block and sold for 75 million. And I remember thinking, I sure wish I knew that was a bargain. I sure wish I had enough
Sure.
money that I could rally some investors and buy that. And the guy who did buy it, he owned it for a few years and resold it for rumor is about 150 million.
Yeah. Yeah. Doubled his money in a couple of years. Yeah.
Yeah.
Absolutely. Yeah. That's what you're talking about is the smart money side of the finances. And that's the side that we work on that have all these different types of private equity opportunities. Our clients participate in bridge loans that we do. So they'll bring the money on board. They get a great rate of return. It's all collateralized, backed by assets, whatever we're issuer we're working with or funder or whatever. And then the Hilton Finance would make money too on that spread, depending on what we're able to loan that money out for whatever project it is. Um, and so, you know, there's plenty of opportunities out there like that on that private equity alternative side.
Right. Well, and it's, it hits me. Those are transactions that aren't regulated by the SEC. Is that right?
Yeah, it depends. It totally depends. But a lot of what can be done, it's amongst accredited investors, people that have done a lot of investing before. Maybe they've had experience in different investments and different LLCs that they've owned. But yeah, there's different structures that you can put them on, and depending on whether they're highly regulated or not.
Yeah. What are some other services? Because, when I think of family offices, I think some are like highly involved all the way down to check writing.
Yes.
So what are some of the other services that you provide that would be traditionally under a family office?
Well, you could go to our website, which is hiltonwealth.com, and then go to the section which is on our family office, and it has a kind of schematic and diagram there of all the different things we can provide. Now, we generally don't go as far as check writing services because people can generally figure out a way to handle that fairly well. But we have on the wealth side, we also have tax planning, which is huge because that helps you build your wealth. We also do risk mitigation, which is a lot of insurances, different types of insurances. We also have business optimization. We have kind of a business planning department where we help our clients make really good decisions on their business planning side. We even have a fleet of planes, which is usually available to our higher level clients in the family office.
Hmm.
But the reason I'm doing a lot of these podcasts and been on podcasts is because we're really promoting Hilton Tax and Wealth Advisors, which is more kind of our retail arm, but helping again retail investors more to take advantage of all these things that can be available on the family office side. And then of course there's depending on the family, sometimes there needs to be some governance, there needs to be some trust structuring, high level trust structuring. I'm not talking about just putting a living trust together, but much, much higher level than that with spendthrift trusts or beneficiary trusts that are much more complex. So there's just a myriad of things that come up. We try to be kind of both in Hilton Tax and Wealth Advisors and the Hilton Family Office, we try to be kind of a one-stop shop, but often we need to outsource, and then we outsource to the what we believe are the best of the best in the business to provide different services.
Yeah. Now, that kind of raises another question. In terms of when you're setting up a trust,
Hmm.
in terms of who the trustee or the executor is, I know a lot of times people want a family member
Hmm.
to play that role. Do you recommend a family member or a third
I
party?
think that's fine if there's a trusted member that has a little bit of experience, has some decent business experience and kind of good common sense. I think that's fine on some of the smaller amounts, but I think when you get to maybe an estate of 10 million plus, it gets a little more complex, and maybe you need an outside administrator for the trust when you're gone. So that gets into what's called legacy planning. So there's estate planning, which is more kind of, we might say, a little bit lower level. Make sure you have a basic estate planning package, living trust, so things don't go into probate and things of that nature. And then when we get to certain levels, and sometimes it's not, I wouldn't even say put 10 million on it. It kind of depends on the complexities of somebody's estate overall. Then we might move into legacy planning, which we might start layering some different trusts in there. We might start doing one of the things we love doing is when people get to certain levels, they're not even aware of it because they haven't been made aware of it, but maybe they can leverage their estate through some, institutional based life insurance products that can take an estate from say 10 million to be worth 20 million overnight.
Yeah.
And products, things like that, and then do some layered trust structuring, like a life insurance trust, things of that nature. So I don't want to get too much in the detail because I mean, literally, you can go so in depth in all of these things, but it really depends on the complexity of someone's estate, their investment portfolios, to where we kind of get more into the complexities of legacy planning or not.
Got it. Let's let's kind of pivot and talk a little bit about the business
Mhm.
of running, wealth management, family offices, and what have you. One of the challenges I've read about is staffing. I think the average age of an advisor these days is like 56 or 58 years old.
Mhm.
The young folks aren't coming into the profession.
Well, I haven't heard that. I mean, we bring people in and internships and different young people. We like younger people because what we do is kind of a little different
Hmm.
than what's going on the retail side, which is where a lot of jobs are. And we like bringing younger folks in because then we can kind of teach them our systems and processes. Where we always say, we hire for character first,
Yeah.
and then smarts. How smart is this person? Because although they might have some experience in the financial world, maybe they've got experience, very limited experience, and but if they're smart enough, if they've got some financial experience, then we can kind of teach them the things that they need to know.
Yeah. Yeah, there's a HVAC company in Charlotte. They've since sold to PE, but when it was still run, it was Morris Jenkins, and when it was still run by Dewey Jenkins, he would not hire someone from the competition. If you'd ever worked for a competitor, you couldn't get a job there. And he
Mm,
actually started his own HVAC school so he could teach people and how they wanted to do things. And it sounds like you're doing a little bit of that yourself. It's
yeah.
bringing the young minds and
Yes.
show them the Hilton way.
Yeah, and they come from the retail world where they've learned a certain way. And sometimes it's a paradigm shift for our clients, just and it's a paradigm shift for employees too.
Yeah.
Because there's like, oh, well, this is a little bit different. How does this, well, because they haven't had experience kind of on the institutional smart money side of the business.
Yeah. What about tech and especially AI? How's that shaping your world?
Well, one of the things that and whether we're dealing with very wealthy clients or maybe more average clients, one of the things we've done and one of the things I've worked on is we believe not only in portfolio building and all of that, but simpler is better. So literally, we try to limit our tech stack to internally, we have obviously a very good CRM program that is specific to our industry. We have then portfolio building, risk analysis, different software with different kind of algorithms, some things that we can put in proprietary ourselves. Um, Internally, that's important. We obviously have, marketing based tech stack things to do a lot of different marketing things we do to get the word out there and so forth. From a client facing perspective, really we have a portal that we can do practically anything on it, that we have our, billionaire clients on, and then our average, more everyday clients on too, that everybody utilizes. We do all our tax planning through there. We do all our wealth planning, everything. So they have one portal, one contact. Then we use Zoom like we're using right now to communicate generally, or if they come into the office, obviously coming into our office, and DocuSign.
Yeah.
And that's pretty much it. And then obviously we use the telephone and email, which you can't get by without. Ironically, mostly what we still use is that out of date, crazy email system.
Right.
So there hasn't been, that was a pretty darn good invention, right?
Yeah.
People still use email to do most of their business. And that's how we communicate with our clients mostly and get back and forth with everybody.
It's funny. I discovered email in 1991. I just moved from Japan back to the United States.
Hmm.
And, 91, I didn't know about the internet. I didn't know about email. And I'm looking at this. Yeah, I'd just been paying $1 a minute to communicate with folks back in the United States.
Yeah.
And I thought, something's wrong here. When the telecom companies figure out this, they're going to find some way to regulate this
Yeah,
because it's
oh, they're
going to
not
shut
gonna
the other
like
revenue.
that. Yeah, yeah. It's
It
like
was
texting. Yeah, that's like texting is somehow they're gonna regulate this or do something. We're not gonna have this for very long.
it was the wildest thing. For
Yeah.
somebody who you know used to have to, I would drive, find a phone booth, and put in my card and call back to the U.S. And it was expensive. And when I
I
saw
remember
email,
those
it's like,
days. Remember the days of the fax machine? Young
oh
people are going to be listening to this going, God, these guys are old.
yeah.
Um, yeah, the days of the fax machine and waiting for faxes to come in and all of that, and then the fax machine breaking half of the time. And yeah, this is the modern ways to communicate are so much better. We found too often because we have a whole texting system and everything that the thing that we do like about texting, it's really easy to get in touch with people
Yeah.
because people look at their texts and they're seeing their text because everybody's got my phone right here. Everybody's got it in front of them all the time, right?
Yep.
They see their texts. Nowadays, there's more and more phone calls getting blocked and, blocking software and all of that. So we find often if we really need to get in touch with somebody quickly or, change an appointment or whatever, the texting is phenomenal. So I did mention we, have that texting system that is kind of an overarching system for our company where we can constantly be in communication with clients too.
That's cool. You mentioned marketing. What are you doing for organic growth?
So, one of our partners owns a very large marketing company,
Hmm.
and does a lot of our social media stuff. We just make sure we have things out there on social media. We do marketing campaigns with some of our other partners on various things, different kind of investment opportunities or the true wealth portfolios, where that we've got some funnels. We use on our marketing side a program called Kartra. I know it's similar to ClickFunnels, I think,
Hmm.
that we do campaigns in there or email campaigns or other types of marketing campaigns and try to get the word out there. We're about to launch a podcast, the Hilton True Wealth podcast, and we're going out to social media and we're announcing it. You may have seen, being connected with us, you may have seen kind of a announcement. We'll be doing two or three and kind of, shooting some email blasts out there. Um, so, I'm not an expert at marketing, but we've got folks that are pretty good at it. We can always be better,
Yeah.
and we're working on being better. But that's our big thing. Brad and I's passion is we've got to get the word out there and get it out there as fast as possible about what we do. Because in our opinion, it's just so much better and so much more powerful than what people are doing on the retail side of the business.
Yeah. Well, and what you've described is amazing. And one of the things I wanted to make sure people didn't miss, the login portal that your billionaire clients use is the same one that someone, with much smaller assets use.
Yeah, yeah,
That's pretty powerful. So
yeah.
the little guy gets the same login, gets the same portal as the big guy.
Yeah, yeah. And so here's the thing that you make that point, but reality is that we work with a lot of our clients that are much wealthier in trying to simplify things. Because what happens is and the sweet spot is about at maybe 10, 15 million. When somebody gets up to that level, they're starting to get over into territory where it's very hard to operate on the retail side of the business.
Mm-hmm.
And what we find often is they have a bunch of different moving parts because you start getting that much money. You have lots of different investments, you have lots of different things going on, and it gets very overwhelming for people. So, but what's ironic about it, you would think, okay, well, then you hire somebody to deal with all of that overwhelmness or all the different moving parts. Well, what's really strange about it is usually we'll bring people on board and then we're like, let's simplify things. So because you want to take, otherwise we find people, they're all over the place. They're spending half a day just dealing with all their money stuff. When they're very wealthy, they should be dealing with the things they want to do in their life and enjoying that lifestyle that they've made for themselves, right?
Yeah.
So ironically, people that I think are really good when they get wealthy, sometimes you'll even see people that are in the billions where their life is a lot more simpler than you would think. And because they design that and they have the money to be able to design that. So really what we try to do overall, it doesn't fit for everybody, but overall we say, hey, all this has caused all this angst. Let's simplify things. Let's consolidate things here. That's one of the things that our portfolios, the true wealth portfolios, do for people. Consolidating things simpler, get that off of your plate where you're constantly worried about buying and selling things. And is this the right money move? Is that the right money move? And then other areas of our life, we can even simplify more and then just make your life a lot more or a lot less complex, I should say.
Well, I tell you what, that definitely whets the appetite because I don't know anybody that wouldn't mind a simpler life. Yeah. Mark, this has been awesome. Again, I hope folks will listen to your episode on leaders and legacies as well. But thank you for coming on Fiduciary Alchemy. How can folks reach you?
Very simple. Just go to our website, which is hiltonwealth.com. They can, watch for my podcast coming out soon, but they can also order one of our complimentary books. Which the main one right now is Hilton Wealth, How to Invest Like an American Dynasty. And then we have another book on tax planning for business owners too. So you're welcome to order those books and we'd love to chat with you.
Thank you.
Thank you.
Thank you for tuning in to Fiduciary Alchemy, the coolest financial podcast you're likely to find. We go looking for voices like the one you just heard because I want you to dodge the mistakes that I made and learn it without the coma, without the drama, without nearly paying the man. I don't know why I lived when so many others died. That part's still a mystery. Now some folks ask, Craig, what is it you do? Well, I'm telling you now, that's no mystery at all. We solve hard marketing problems in crowded markets so good folks like our guests can rise above the noise, become visible, memorable, irresistible, and grow like never before. If organic growth is your problem, reach out, call me. Let's make a plan and bring your next steps into the light. But don't leave yet. Stick around a minute more and listen to Bluesman Grendel and the Compliance Choir deliver a word of caution just for you.
This podcast is for information, education, that is all. It is not financial, tax, or legal advice to guide your call. Nothing here's an offer, nothing here's a buy or sell. No recommendation no solicitation. I'm saying it plain and well.
Plain and well. Plain and well.
Past performance ain't no promise of what tomorrow brings. Markets turning, people lose on all kinds of hopeful things. Every investment carries risk. Principle can fade away. What works for one won't fit us all. That truth is here to stay.
Fade away.
Fade away.
Here to stay.
Yeah, that's the compliance blues. Lord, the compliance blues. Get your own financial, tax, and legal help before you make your move. That's the compliance blues. Your situation's yours alone. Your needs are not the same. Different facts and different goals can change the whole damn game. So talk to somebody qualified before you choose your road. Because the weight of every money move is your own load to hold. Your own road. Your own load.
Your own load.
Well, that's the compliance blues. Lord, the compliance blues. Get your own financial, tax, and legal help before you make your move. That's the compliance blues.
Informational only. Educational too.
Get qualified financial, tax, and legal advice that is right for you.